Bitcoin's current bull market is unfolding in a way that closely resembles the 2015 to 2018 cycle. There's a lot happening beneath the surface, and in this video, I'm breaking down the data you need to understand what's really driving the market. We'll dive into the realized cap, ETF flows, and the massive capital rotation happening right now. To get a real sense of where we stand, let's first take a look at Bitcoin's performance during previous bull runs. If we examine the chart showing Bitcoin's price performance index relative to the cycle low, a clear trend emerges. Over time, the rate of growth has naturally slowed. As Bitcoin's market cap expands into the trillions, larger moves require exponentially more capital. This is a normal phase for any maturing asset. And as Bitcoin continues to evolve in the market, this is something we can expect to see more of. What we're witnessing now follows a familiar bull market structure. It begins with a phase of steady, controlled growth, followed by a market shift into high gear, driving prices up sharply. Right now, we seem to be at a pivotal point, and if history is any guide, this could be the moment when Bitcoin enters its next major breakout phase. If we take a step back and look at the bigger picture, there's a clear and significant parallel between this cycle and the 2015 to 2018 bull market, particularly when it comes to the dominance of spot demand. During that period, the derivatives market wasn't as developed, and stablecoins hadn't yet established themselves as a major force in the market. Back then, the driving force was primarily spot buying, with fewer players influencing the price from the leverage side. Fast forward to today, and although the market has changed in many ways with the growth of derivatives and stablecoins, spot demand is still a major player. This is especially noticeable when we look at the pullbacks throughout this cycle. If we zoom in on the chart tracking the drawdown profile during previous bull markets, what stands out is just how similar the recent corrections are to those we saw in the 2015 to 2017 rally. In both cases, the pullbacks have primarily landed within the same Fibonacci retracement levels, between 10.1% and 23.6%. It's a pattern that has been remarkably consistent, giving us a framework to anticipate where Bitcoin might go next. That said, it's important to keep expectations realistic. The explosive returns we saw in 2015 to 2017, over 100x from the lows, are unlikely this time around. After all, the starting point for this cycle was around $15,000, not a few $100s. However, even with Bitcoin's significantly larger market cap today, corrections since the FTX collapse have rarely exceeded 25%. This level of resilience speaks volumes about the strong underlying demand, reinforcing Bitcoin's position as a macro asset. A key contributor to this demand is the rise of spot Bitcoin ETFs. These funds have quickly become a major force in the market, injecting substantial capital and driving prices higher. Now, let's dive into the realized cap, one of the most powerful metrics for tracking capital inflows into Bitcoin. The realized cap measures the total value of all Bitcoin based on the price at which they were last moved, rather than the current market price. This gives us a clearer understanding of how much capital has actually entered the market. In Bitcoin's early years, realized cap grew exponentially, by 122 times in the 2011 to 2015 cycle alone. But as Bitcoin matured, the growth rate naturally slowed. Currently, the realized cap has increased by 2.1 times from the cycle low, indicating strong growth. But it's still quite a bit lower than the 5.7x peak we saw during the last cycle. This is particularly interesting because it closely mirrors the trajectory of the 2015 to 2018 bull market. What's even more intriguing is that, in previous cycles, we've observed a clear inflection point where Bitcoin enters its euphoric phase, when realized cap suddenly surges as demand spikes, pushing the market into overdrive. If we follow this historical pattern, there could still be substantial upside ahead before this market cycle peaks. As demand continues to build and momentum gathers, we could see the realized cap accelerate, signaling that the market has further room to run before reaching its top. This potential roadmap gives us some insight into where Bitcoin might be headed in the months to come. One of the most powerful dynamics fueling bull markets is the rotation of capital from long term holders to new investors. As prices rise, long term holders begin to take profits by selling Bitcoin that has been sitting in their wallets for years. These coins are then absorbed by new buyers, and as long as demand remains strong, the bull market continues its upward trajectory. Since December 2023, we've witnessed 1.2 million Bitcoin shift from long term holders to new buyers. During the recent surge past $100,000, 1.1 million BTC changed hands at prices above $90,000, highlighting the massive demand absorbing the selling pressure at these levels. This capital rotation is a crucial signal of market health, indicating that fresh capital is entering the space. By examining this capital rotation more closely, we can identify two distinct waves of distribution in this cycle, both of which are comparable in scale to what we saw in early 2021 and late 2017. In those previous cycles, after peak sell side pressure had been absorbed, Bitcoin continued its rally for about a month before demand started to taper off, which eventually led to a shift into a more passive hodling phase as the market cooled. Tracking this pattern helps us understand the flow of capital and offers insight into potential market movements in the near future. Let's now turn our attention to exchange balances. Since mid 2024, Bitcoin reserves on exchanges have dropped from 3.1 million BTC to around 2.7 million BTC today. Many people assume this decline signals a supply shock, suggesting that Bitcoin is being pulled off exchanges and locked away, creating upward price pressure. However, that's not the full story. In reality, a significant portion of that Bitcoin hasn't disappeared. It's simply been moved into the custody wallets of Bitcoin ETFs, particularly with Coinbase. After the SEC approved spot Bitcoin ETFs in January 2024, 8 out of the 11 approved ETFs chose Coinbase as their custodian. When we account for the Bitcoin held by these ETFs, the total amount of Bitcoin either on exchanges or in ETF wallets has actually remained fairly stable, hovering around 3 million BTC. This shift in market structure is crucial. The reduction in exchange balances doesn't necessarily mean there's less supply available. It's more about a structural change in the market, as ETFs are now holding a larger portion of Bitcoin's supply. This transition is an important trend to watch, as it influences both supply dynamics and the broader market landscape. Looking at everything we've covered, there's a lot to be excited about. Bitcoin's bull market still has significant upside potential. The realized cap hasn't reached the euphoric levels we've seen in past cycles, suggesting there's room for further growth before we hit the top. This gives us a clearer sense of what might come next. The shift in supply dynamics is also crucial. While Bitcoin is moving off exchanges, much of it is going into ETFs, especially with Coinbase as the custodian. This doesn't mean there's less Bitcoin available, but it does indicate a shift in how Bitcoin is being held, which could have a big impact on the market structure going forward. Another key factor is the ongoing capital rotation. Since December 2023, we've seen millions of BTC move from long-term holders to new buyers, soaking up the selling pressure and fueling the rally. This influx of fresh capital is helping to drive the market higher, and if this continues, we could see the momentum build even more before demand starts to slow. There's a lot happening beneath the surface right now, and Bitcoin's market structure is shifting in ways that could set the stage for some interesting developments in the months ahead. And that's all for today's analysis. Thanks for tuning in, and I'll see you in the next one.